Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, October 29, 2024. Hope you're having a fantastical day out there in the interwebs. Another nice day here in Colorado. Probably our last. Today's highs were in the high 60s. Tomorrow's high is in the 30s. So, woohoo! Anyways, all right. Well, I hope you're having a great day out there. And before we jump into the markets for today, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All righty, let's jump into the markets. Dow Jones, God, these things popping up on the screen. Dow Jones was down 0.36%, 154 points, closed at 42,233. S&P 500 up 0.16%, 9 points, closed at 5832. NASDAQ up 0.81%, 150 points, closed at 18,717. The VIX was down 2.32% today. It's at 1934. Canada down 0.01, Brazil down 0.32, and Mexico down 1.27. In Germany, or in Europe, Germany was down 0.25%, the UK down 0.8%, France down 0.61%, Netherlands down 0.24%, Spain down 0.91%, Italy down 0.26%, Switzerland down 1.11%, and Portugal down 0.27%. Russian exchange is finally back in the green. The MOEX up 0.94%, the RTSI up 0.84%. And the overnight markets, the Nikkei was up 0.6%, Australia up 0.34%, New Zealand up 0.55%. In China, the Shanghai was down 1.08%, the Shenzhen component down 1 1/3, China A50 down 0.78%, DJ Shanghai down 1.03%, Hang Seng up 0.49%, and the Taiwan weighted down 1.17% for the day. All right, good stuff. Alrighty, let's get into our market recap for today. U.S. stocks mostly higher as tech strengthens ahead of Alphabet earnings. U.S. stocks mostly rose Tuesday as investors awaited Alphabet's earnings and digested weaker labor market data. Major tech stocks rallied ahead of Alphabet's quarterly results expected after the market close. Analysts anticipated Alphabet's advertising growth will align with forecasts through caution on search growth and YouTube's competition. This week's tech earnings, including Meta, Microsoft, Apple, and Amazon, are anticipated to signal broader market trends. Investors will focus on whether these companies' extensive investments in artificial intelligence have translated into positive returns. Ford stock dropped 8% after revising down its full-year profitability forecast, citing supply chain issues and warranty costs. Excuse me. UBS noted that ongoing warranty expenses have continued to impact Ford's financial outlook. VF Corporation, parent of Vans, surged 22% after posting its first profit in 2 quarters, while D.R. Horton and McDonald's experienced mixed reactions to earnings reports. Labor market insights also influenced sentiment as the JOLTS report showed a decrease in job openings, signaling reduced labor demand. Oxford Economics noted that this, along with a lower quits rate, suggests wage growth and labor-driven inflation pressures are easing. Additional labor data from jobless claims, ADP payrolls, and October's jobs report later this week will further clarify labor market trends. Inflation remains a focal point, with the Fed's preferred core personal consumption expenditures price index due on Thursday, which could shape the Fed's expected rate cut at its upcoming meeting, which will be on November 6th and 7th. All right, looking ahead, the U.S. presidential election on November 5th is shaping up as a close contest, with recent polls showing Republican nominee Donald Trump slightly leading over Vice President Kamala Harris. I know I said her name wrong. I don't care. All righty. Well, that's kind of everybody's waiting around to see what's going to happen with the tech giants and see the Magnificent Seven, see what, are they going to continue to drag the market along like they have all year, or are things going to slow down? So we shall see. All right. Next up, article from Zero Hedge, shocking drop in job openings after massive downward revision, quits plunged to an 8-year low. In September, U.S. job openings dropped significantly, falling from over 8 million to 7.4 million, the lowest level since early 2021. This sharp decline followed August's unexpectedly high job openings report, which had shown a rise to 8.04 million, but was later revised to 7.861 million. The new September numbers reflect one of the largest shortfalls on record, with the Bureau of Labor Statistics, the BLS, reporting a decrease of 418,000 job openings, even factoring in the revision. Key sectors affected expected, included healthcare and social assistance, with a reduction of 178,000 openings, and government roles, excluding education, which saw a 107,000 person drop. Conversely, finance and insurance sectors experienced growth with an increase of 85,000 job openings. In the construction industry, which had previously shown a sudden rise in job openings, despite a sluggish housing market, openings dropped by 40,000 to 288,000 in September, possibly indicating data adjustments by the BLS after skepticism from analysts. Additionally, the number of job quits, a sign of worker confidence, declined to 3.071 million, marking the lowest since October of 2016. While the number of hires increased slightly by 123,000, the overall labor market signals potential weakness as quits, a proxy for job mobility, continued to decrease. A concern highlighted in the report is that 70% of the JOLTS data is estimated due to low response rates in surveys, raising questions about the accuracy of its metrics. Yeah, pretty much anything out of the government is probably BS, unless you actually can verify it through a third party, but is what it is. All right, one more article here from Zero Hedge. Is the dollar collapsing? 7 key indicators you can't ignore. All righty, where was I? Here we are. In his article, Nick Giambruno highlights 7 indicators pointing towards a U.S. dollar crisis driven by an escalating debt spiral and financial instability. First, federal budget deficits. Despite assuming no new major expenditures, the U.S. is projected to accumulate over $22 trillion in deficits in the next decade. This debt reliance underscores unsustainable fiscal policies. Next is federal debt. The national debt, or the republic's debt, now exceeds $35 trillion, over 123% of GDP. As government spending inflates GDP, the real debt burden on the productive economy is much greater than it appears. Interest expenses. Interest on the federal debt has reached $1 trillion annually, now surpassing even defense spending. Soon, interest expenses will exceed Social Security, becoming the largest federal expenditure, forcing the Fed to keep rates artificially low to manage costs. And, that'll really help inflation. No, it won't. Number 4, the federal funds rate. After rapid rate hikes, I wouldn't call it rapid, to combat inflation, the Fed has shifted back to easing, pressured by rising federal interest burden. This policy risks long-term inflationary pressures. Yeah, we've already seen that the M2 money supply is growing. Next up is the money supply growth. The Fed's easing policies increased the money supply, diluting wealth. Since 2020, the money supply has surged by 37%, devaluing dollar holdings. It was as high as about 40%. They came back a little bit, and now the money supply is starting to increase again. This Consumer Price Index. Giambruno argues that the CPI underestimates true inflation due to political manipulation, downplaying the effects of currency devaluation on purchasing power. And last, gold prices. Gold, historically resilient against currency debasement, is reaching record highs. As faith in fiat currencies wanes, Giambruno expects gold to be increasingly valued as a stable store of wealth. With these indicators suggesting increased debt reliance, currency devaluation, and inflation, Giambruno anticipates significant gains for gold as a refuge asset, recommending secure offshore holdings as a hedge against potential dollar instability. And if I could add my own little hypothesis into this, is I think we'll probably see the other major currencies really start to tumble first. And the dollar will be the, fiat of last resort. And I mean, that's really why the dollar has been, really as strong as it has been over the last, 3 years. I know in the summer of 20, we were around 90 in the dollar index. And shortly after that, all the money printing and around the globe, and the dollar index went up, I think as high as about 110. And right now it's sitting around 104-ish. It was 103, 104 last night when I last checked it. So, what I would say is, you'll probably get a heads up that currencies are starting to fail. So, you'll see the British pound, the euro, the yen, all of those will start to have some real problems. And, people in those countries will then flock to the dollar because, they think the dollar's safe. Well, we know. And then at that point, once the dollar is the last man standing, what are you going to do? Continue to inflate it at that point, and then, things all fall apart. So again, you'll have a heads up, you can kind of see the storm clouds on the horizon at some point, but again, be careful. It could happen here first. I mean, I could be wrong, but, based on the smart people I listen to, that seems to be their their hypothesis moving forward. So, all right. Well, that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. You can go get all your financial planning needs addressed, so feel free to give me a call. I'd be happy to help. Ooh, there's a spider on my desk. All right. Well, I hope everyone has a wonderful evening, and I'll talk to everyone again next time. Adios.